broadly speaking, we are in a very robust economy. Elaine Garzarelli, when was the last time you heard that name, said we're in the most robust economy she's seen in 50 years. Kind of surprising.
First of all, she's still with us.
Oh, yeah.
And
And active. And with clients, absolutely.
And just remind our audience, Elaine Garzarelli
famously called the 87 crash. She got that right.
Thank you.
She had a kind of mixed track record after that. But anybody who got that crash right, you got to give mad props to. So the two conflicting information is, on the one hand, we have a very robust economy despite the highest rates in 20 years. Yet at the same time, we are seeing evidence that higher rates are beginning to have an impact on the consumer. Doesn't mean we're crashing, doesn't mean a recession is coming, but things are beginning to slow down. And again, if I was Jerome Powell, I would have taken 25 basis points down in the June meeting, and I doubt he'll do that in July, but he should.
In the time of Elaine Garzarelli, and we said greetings to Maria Bartiromo the other day, her 25th wedding anniversary. In those times, there was paper. I know some of you younger won't believe this. There are actually published reports. Tuesday was the big day of delivery of reports. Mona Mahajan was at C.J. Lawrence, et cetera, et cetera. Nowadays, all you do is wait for Sam Rowe to publish, because Sam Rowe aggregates, and you aggregate from Sam Rowe. First of all, I've never seen Sam without a beverage of his choice in his hand. That's a starting point. But he's been on fire recently. What are you stealing from young Rowe?
So first, Sam's Substack is called Ticker, T-K-E-R. He's one of the rare birds who are completely objective, totally data-driven, very evidence-based, and wholly unemotional, which is, let's talk confirmation bias. That's right in my sweet spot. So over the weekend, Sam puts out a run of 6 reasons to be bullish about this market. And one of them is from a firm whose data I used to see all the time, Global Financial Data. They did a research piece that looked at 235 years of market concentration. And essentially what Brian Taylor, their chief economist, found was that market concentration is very much a quality of U.S. equity markets. And we've gone through 7 periods of intense concentration, depending on what is the dominant sector of the economy and what is that driving in the stock market. Sometimes it's financial, sometimes it's railroads and transport, sometimes it's industrials. Obviously, this cycle, it's technology. Arguably, you look at the 80s and 90s cycle, that was also a lot of technology. And so when you get these giant, long-lasting cycles, and some of these are 50 years long, they dominate the economy, they dominate the market. The flip side of this is Dan Gross's book, Pop, Why Bubbles Are Great for the Economy. What Gross says is, hey, if you like all of these AI stocks, buy them all, or just wait until after they blow up and pick out the winners, or pick out a basket of them really cheap. But think about every major technology, fiber optics, computers, radio, telephone, just go down the list. Each technology has this boom period. Everything gets a little crazy. Then there's a bust, and then you get to pick up things on the cheap. Internet retail, don't forget, Amazon was $5-6 in 2000, 2001 after the dot-com blew up. This is the cycle, this is the pattern that repeats over and over. I wish I could tell you when and where. I'll tell you exactly where to short and exactly where to buy, but we find that nobody can really do that.
How are the dogs?
Dogs are great. They spend most of the summer in the pool. And it's not our pool. They let us use it occasionally. We literally have this dog float, this canvas raft, and the Portuguese water dog, obviously, in the pool all summer. But the rescue, he's chasing the little. We have these floaty toys we throw in.
You play lifeguard?
I think they play lifeguard. It's they're younger and healthier than I am. So.
Barry Ritholtz, thank you so much. Greatly appreciate it.